Good evening, traders. I am Himali Bhatia from the Financial Analyst, and I welcome you to the Bold Project. In this module, we have been discussing about the candlesticks, and in our previous episode, we spoke about the anatomy of a candle, the working of a candle, and we analyzed the candle in isolation to understand who is in control. All right. In this episode, what we will do is we will be spotting a few patterns on the charts and we will be seeing if we should take that as an entry or an exit point or not. So let's get started with this. My focus in this episode will be to talk about the two candle patterns, and in the next episode, I will be covering the one candle patterns. All right. So before I get started with the candle patterns, let me tell you one thing over here. There is a structure that we need to understand. All right. Now, in the previous episode, I had mentioned that the patterns are categorized into three different classes. The first class being one candle patterns, the second class being two candle patterns, and the third class being three candle patterns. But all these one, two, and three candle patterns, these are subclasses of your two big classes. Your two big classes are first, which is known as a bullish reversal pattern. Now, what is the structure for a bullish reversal pattern? The structure is that first there will be a downtrend in the market, an existing downtrend, followed by a candle pattern at the bottom that will be discussed with you, followed by an uptrend or a reversal in the market. All right. Such sort of a structure where we have an existing downtrend, at the bottom we spot or identify some sort of a pattern followed by a reversal on the upside. Such sort of a market structure is known as a bullish reversal market. Similarly, we have the bearish reversal. Bearish reversal is nothing but there is an existing uptrend, there is some sort of a pattern which is identified at the top, and from there what is happening is there is a reversal in the market. The markets are now falling down from there. So such sort of a structure is known as a bearish reversal, and all these patterns, your one candle, two candle, or three candle, will follow either of the two structures, either your bullish reversal or your bearish reversal. All right, traders, let's get started with the two candle patterns. Now the name, these patterns have names attached to it. All right. Now the name of the first pattern over here is known as a bullish engulfing. Now what I want you to do is, now I understand that some of you might already have a brief understanding of what candle patterns are. But what I want you to do is become a clean slate, forget about what you have learned, and just follow what I am telling you over here. Only then you will be able to master your analysis in candle patterns. Now, what I will be doing is I will be giving you a set of criterias over here. All right. So, for your bullish engulfing, the first criteria is that there should always and always be an existing downtrend. If the bullish engulfing pattern, I have not shown the pattern as yet, but if the bullish engulfing pattern is found in an uptrend, that means that is not a pattern over there. There is no pattern over there. It may look like a bullish engulfing, but it is not a pattern. So your first criteria says that it should always be spotted in a downtrend at the bottom. Now, how does the pattern look like? The pattern looks like something like this. There is a red candle followed by a green candle which completely engulfs the red candle. Engulfs means it completely covers the red candle. All right. The second criteria over here that we have to look at is, now we as traders, what we do is we should never take a trade on the day of the pattern. Over here, the bullish engulfing is there. The green is engulfing the red, completely covering the red. This is showing that the buyers are dominating the sellers. But we as traders have already taken a lot of risk in the market, and we will not immediately take a trade on the day of the pattern. we will always wait for the next day, which is known as the confirmation day. Now, what do I want in a confirmation day? Ideally, what I will wish for is a gap up opening. What is a gap? The open price of the next day will be any point higher than the previous day close. So if the previous day close was 100 rupees and the next day the open price is 101 or 100.1 paisa also, still it is considered as a gap up. So ideally gap up represents that there are buyers in the market. All right. Now, what do I want with a gap up? Just a gap up is not sufficient for me. What if there is a gap up and then there are sellers in the market? That means sellers on the confirmation day itself have shown their dominance and there is a high probability that the prices can go down. So what I will wish for is a gap up, not only a gap up, but a buyers and control market. All right. So this sort of a confirmation is something which is ideal and you won't always and always see this picture. If this is there, this is wonderful. If it is not there, then what should be done? If there is no gap up, what I will wish for is I will at least wish for a buyers in the market. Right? Next, if buyers are still taking control, that is also sufficient enough for me. So we have the first criteria, there should be a downtrend. The pattern is established, that is a green completely engulfing a red. And then the second criteria, there should be buyers in the market. Now, will it always be a green candle? No. Yes, in the previous episode, we learned how to determine who is in control. That is to be checked over here. All right. Now, there's a third criteria over here. The third criteria is that on the day of the confirmation, as well as on the previous day, that is this day, the volume should be high. What does high volume mean? I've already explained this in the previous episode that the bar should either touch the average. The black faded line over here is your average. So the bar should either touch the average or reach the average on the upside. All right. That is known as a good volume. So volume should be high or good on both these days. Now these criteria constitute up to 90% of the trade. So if these are fulfilled, it is suffice enough for me. However, there is something known as your signal enhancements. All right. Now what is a signal enhancement? Signal enhancement is nothing but your criteria only. But this constitutes only about 3 to 5% of the trade. And this is something which is not at all important to me. So from a beginner level, you might place focus on your signal enhancements, but as and when you grow in your trading, signal enhancements is something which is not very important. All right. However, let's cover the signal enhancements with you. The first signal enhancement over here is that if this green candle is able to cover the shadows of the red candle, previous day red candle as well, then this picture is stronger than if the green candle is unable to cover the shadows of the red candle. So what I mean to say is, if there is a picture like this, all right, there's a red candle in a downtrend, there are shadows, this is a red candle, followed by a green candle, which is completely, the green body is completely engulfing not only the red body, but also the shadows. Then this picture is stronger than something like this. This is your red candle in a downtrend. There are shadows, but this time the green body is unable to cover the shadows of the red body. So this picture is slightly weaker than this picture. However, this is under signal enhancement and this really does not place too much focus. The second signal enhancement over here is that the longer the green body, the much better. Now again, this is very subjective. Why? Because long for me can be something this, long for you can be this, long for some third person can be this. So this is something which is relative in nature. All right. However, it is being covered under the signal enhancement. And from here, what I can expect is a reversal in the market. And I can take a trade on the day of the confirmation, provided your first, second, and your third criteria fulfills. I can take a trade, and from here, I will expect an uptrend in the market. Now, there is one more additional point that I'd like to cover over here. That is again slightly from an advanced point of view. What I will wish for on the confirmation day, an additional point over here is that if the closing price of the confirmation day is higher than the previous day high of the candle, then only I will take a trade. If it is unable to breach the previous day high, then I will avoid taking a trade in the market. So again, this is something slightly from a advanced level point of view. And what you should do is first practice with the basics, and then you can take note of these points right now and gradually introduce them in your trades, all right, or in your practice. Now, despite all the criterias getting fulfilled, there is always that risk element in the market. What if there is some bad news immediately after the confirmation day, or something happens to the stock, or out of nowhere the sellers come into the stock? So, what we do is, from a safety point of view, from a risk management point of view, we will place our stop loss in the market. What is a stop loss? It is a level at which if the prices cross that level, it will stop from further bigger losses. All right. It will protect our losses. It will only limit our losses, protect our capital, and we won't be making huge losses. So where do I place my stop loss? How do I place my stop loss is something which will be covered in the other module. But right now, just understand how do I place my stop loss in case of a candlestick. And in your price action trading, the stop loss, the placement of the stop loss will be changed. So for now, please stick to what we are explaining over here. So my stop loss will be placed on either of the green candle or the red candle, whichever has a larger lower shadow. The lowest most part of it will be considered as my stop loss. All right. So let's say you took a trade over here and suddenly something happens in the market and the market starts falling down. So your losses are stopped over here and you will not make further losses. All right. Now, each pattern has an opposite version of it. So just like your bullish engulfing, there is something known as your bearish engulfing in the market. Again, we'll play by the criterias. Criterias are something which is very important. Now, you don't have to mug up the criterias because the criterias are very similar to the patterns, all right? So first criteria over here is that there should be an existing uptrend in this case, all right? So prior to the pattern, there should be an existing uptrend. How does the pattern look like? So first, there will be a green candle followed by a red candle which completely engulfs the green candle. All right. Engulfs means it completely covers the green candle. Now let's talk about the second criteria. Second criteria was we always take a trade on the day of the confirmation. Now, how should my confirmation look like? I will ideally prefer for a gap down in this case. That means my open price should be lower than the previous day closing price. All right. So this is my close. Anything below this. So my open price is below my closing price, but will the gap down suffice? No. I will also wish for a seller's dominant market. Should this be a red candle? Not necessarily, because in the previous episode we understood how the candlestick shows who is in control. So I want a seller's confirmation on this day. From the advanced level point of view, what I will wish for is the closing price of the confirmation day should close below the previous day low. All right. So again, this is a advanced level point of view. If it is closing something like this, let's say there's a gap down, but it closes above the previous day low, then I will avoid taking a trade over there. I hope that clears the concept to you. All right. Now, gap down, sellers in confirmation or sellers in control is an ideal situation. That always does not happen in the market. So, what can we do in the market if there is no gap down? So, if there is no gap down, then I will at least wish for a seller's confirmation in the market. And I will take my trade on this day, provided the third criteria gets fulfilled. What is my third criteria? On the day of the confirmation, as well as on the previous day, on these both days, the volume should be high. It is covered in a Dow theory. Volume is neither buyer specific nor seller specific. If even if it is selling in the market, I would not wish for lower volumes. I will wish for high volumes in the market. All right. Let's talk about the signal enhancements in this case. The signal enhancements are the same thing over here. If the red candle is able to cover the shadows of the green candle as well, wonderful. If not, it really does not matter. Second signal enhancement, longer the red body, the much better. Again, that is something which is relative and it might change from person to person. Now, despite all the criteria getting fulfilled, of course, we'll expect a reversal in the market. But despite all the criteria getting fulfilled, there is still risk in the market. And what can happen is there can be some positive news or buyers can suddenly be established in the markets. And what we will do is we will place a stop loss. Now, why are we talking about the stop loss in this case? Isn't this an exit point to me? So this can either act as your exit point or it can also act as your entry point. Now, how is this my entry point? The traders can short the stock. Now, this is something which is not possible for swing traders. Why? Because shorting in India, shorting a stock is in India is limited to only your intraday. So before your 3:30, the market close, you have to square off your positions if you take a short position in the market. However, for your swing traders, what is an alternative for them? They can buy a put option. What are options? That will be covered separately. All right, that is in our other program. So you can Google what is a put option, and you can see that the trader or the swing trader can search. Can take a put option, and he can take an advantage on the downside as well. So where will I place my stop loss in such a case? The uppermost part of either of the two candles of the pattern. So whichever has a longer upper shadow, I will take that as my stop loss. All right. So this for the two patterns, and let's take a few examples from the charts. So in the first case over here, now this is Nifty day chart, and I have spotted a few examples already. But before we analyze the examples, let me tell you one important point over here. Investing.com is showing us volumes for Nifty, which is a wrong picture. Index does not have volumes. What investing.com is doing, it is taking an average of the volumes of all the stocks covered under Nifty and it is plotting a volume over here. All right. So what we will do is we will not consider the volumes for Nifty, Bank Nifty or any other index. Otherwise for stocks, it is okay. The other question that I would like to answer over here is some people have a question that can we look at the Nifty futures volume to determine what is the volume of Nifty? No. Those both are not in sync. That is something which is a different product. This is a different product. So you won't take those volumes to compare it with your Nifty volumes. All right. However, from an example point of view, from an example sake, in this case, I am taking volumes and I'll be showing you different stocks as well, but you don't have to take the volumes. All right. Let's take the first example over here. So what is the pattern I have spotted? It is a bearish engulfing. So let's start with the criteria. The first criteria is that there should be a prior uptrend. Was there a prior uptrend? Yes, there was a prior uptrend in the market. The pattern has been established. Now let's talk about the second criteria, the confirmation. Now on the day of the confirmation, what has happened is there is indecision in the market. So what do we do in such scenarios? Himali did not talk about it, so I will cover it over here. If on the day of the confirmation, if there is indecision in the market, then I advise all my clients to wait for one more day for the confirmation. If again on the day there is indecision, then again wait for one more day. Until and unless there is some sort of a confirmation, you will not consider. If there is indecision, you will keep skipping those days. All right. So over here, there's indecision in the market. So I will ignore this day, and this day does not become my confirmation day. The next day becomes the confirmation day. Now, on the day of the confirmation, what was the criteria? The criteria was that I ideally will prefer for a gap down sellers in confirmation. If there is no gap down, then at least I will wish for a sellers in confirmation. But in this case, what do I see? I see that there have been buyers established in the market. So will I take my trade over here? No, I will not take my trade over here. This is not the right entry point for me. Is it clear? All right, let's take one more example over here. Again, this is a bearish engulfing. All right. How is this a bearish engulfing? Let's go through the criteria. The first criteria says that there should be an existing uptrend. So there was an existing uptrend in this case. Now let's talk about the second criteria. Second criteria was the confirmation day. Now in this case, what has happened is the open price was lower than the previous day closing price. So there has been a gap down in the market. However, during the day, the buyers have shown their dominance in the market. That is why in the explanation and the concept, I told you if there is a gap down, that is a value add, but I will also look for a sellers in the market confirmation. But in this case, what has happened is buyers were there in the market. So what I will do is I will not take a trade. Good thing I did not take a trade, because from there, the market started moving up. And the people who would have shorted the stock or the index over here, they would have ended up in huge losses. All right. Let's take more examples. Now, what is happening in this case? We spot the pattern at the bottom, and this is my bullish engulfing. Now, from a signal enhancement point of view, yes, the green is not covering the shadows of the red. But like I told you, signal enhancement is something which is not very important. In totality, this is my bullish engulfing pattern. So let's go with the criteria. The first criteria was that there should be an existing downtrend. All right, there is an existing downtrend. The second criteria, the confirmation. There should be ideally a gap up, buyers in control confirmation. If there is no gap up, then at least there should be a buyer's confirmation. So what is happening in this case? We got the ideal scenario. There is a gap up. The open is higher than the previous day close. And also there are buyers in confirmation. Over and above that, the advanced point of view, the closing of the confirmation is higher than the previous day high. So it has broken the previous day high. So that is again one additional point over here. Now let's talk about the third criteria. The third criteria says that the volume should be high. Now on the day of the confirmation, as well as on the day of the pattern, the previous day, the volumes were low. And what I will do is I will not take a trade in such a scenario. However, in the beginning itself, I mentioned that Nifty volumes are not true in nature. And from here, if we would have taken a trade, there was a good uptrend in the market. All right, let's take one more example. Now, again, there is a bearish engulfing. So for a bearish engulfing, the first criteria is that there should be an existing uptrend. Yes, there is an existing uptrend. The bearish engulfing has been established. Now on the next day, what is happening is there is a gap down as well as there are sellers in the market. Now, some analysts consider this to be an indecision in the market. So again, this is something which is very subjective. I will consider this as sellers in the market, but a few analysts might consider this as indecision. So what you can do is wait for one more day. In either of the case, what is happening is the sellers are there in the market and the volumes for both the days are also good. And the volume for the day of the pattern is also good. Now for this confirmation day, if you could clearly see over here, the volume has it's just shy of the average. All right. So like I told you in the earlier episode, small deviations are something which are to be neglected, and very small deviations, if the bar is just shy, like in this case, or maybe in this case, if it is just short of the average, then I won't consider that to be a very big difference. I will consider that as good volumes only. So in this case, again, volumes were good on both the days. I will take a trade over here, and good thing I took a trade over here. The prices made a low of 11614, and we took a trade on the day of the confirmation. Let's say on the closing price only 12169. So that was a really good profit over here. All right. If you would have taken a put option. Let's see if we have more examples over here. All right. So there are two examples in this case. Now, before I explain the examples, do you see these symbols P, which is these symbols are available on investing.com. And what you have to do is you have to completely ignore these symbols. These are completely useless. All right. It is nothing to do with what you're learning. These are just auto generated. It is not fulfilling the criteria. It is just showing you that there is some pattern over there. And on many occasions, it is wrong also. I don't want you to rely on this automated system. I want you to rely on your own analysis. All right. So let's get started with the example over here. So these two candles constitute to be a bearish engulfing. So what was the criteria for bearish engulfing? On the first day, the first criteria was there should be an existing uptrend. Now again, this is something which is slightly subjective. Why? Because a few people might think that this is a downtrend and the pattern has been found in a downtrend. But what I see is that just before the pattern, there was a brief upside movement. If you look at the points, it is covering the points very well, about 100 or even more than that it is covering. All right, 200-300 points it's covering on the upside, so which is very good. So that is why I will consider this as the first criteria getting fulfilled. Let's talk about the second criteria. Second criteria says that the confirmation day. Now, on the day of the confirmation, there is indecision in the market, followed by another indecision in the market. So what we have to do is we have to patiently wait and not take a trade. Finally, on this day, we see a seller's confirmation in the market. Though there is no gap down, but at least there is a seller's confirmation in the market. I can take a short position over here. Good, I took a short position over here because now the prices have fallen down and I have made good money over here. Clear? Let's take this example. There's an existing downtrend. This is the bullish engulfing, followed by a confirmation day. Now, on the day of the confirmation, who is in control? Sellers are in control. Will I take a trade? No, I will not take a trade. Why? Good thing I did not take a trade. It briefly moved up and then it came down to hit my stop loss. So what was my stop loss in this case? The lower shadow, which has a longer lower shadow of the pattern. This one has a longer lower shadow, the lowest most part of it. So the low of that will be the stop loss. And what has happened? The stop loss has been triggered. All right. So that was not a entry point for me. Let's talk about this scenario. There is a bearish engulfing in the market, and prior to that, there is an uptrend. So your first criteria is fulfilled. All right. Let's talk about the second criteria. Second criteria says that ideally there should be a gap down, sellers and confirmation. So that is also happening. And the third criteria says that volume on the day of the confirmation as well as on the day of the pattern, just the prior day to the confirmation day, the volume should be high. And in both the cases, you can check the volumes. The volumes were high on both the days. On both the days, it was breaching the average. So I can take a short position from here. And what has happened? There is a huge downfall in the market, booking huge profits for the traders. All right, let's take another example as marked over here. There is a prior downtrend followed by a bullish engulfing. Now let's quickly cover this. Criteria number one, downtrend is there, bullish engulfing is established. Okay. Second criteria, confirmation. There is no confirmation. There is in fact sellers in the market. Will I take my trade over here? No, I will not take my trade over here. Now, immediately after that, you can see again the market has created this bullish engulfing again, right? So there's again still a downtrend in the market. First criteria is fulfilled, bullish engulfing established. Next day on the day of confirmation, though there is no gap up, you can see the open price is within the previous day candle. So there is no gap up, but still there are buyers in the market. So your second criteria is also fulfilled. Let's talk about the third criteria. On the confirmation day, volume is there, but on the previous day, volume is just shy of your average. So again, this is a small deviation that I can neglect, and I can take a trade on the day of the confirmation and the prices moved on the upside, booking good profits for me. All right. So let's take a few more examples from the stocks now. Again, just before I move to the stocks, Nifty does not have volumes. This was just from an illustrative purpose. Do not use this while trading in the market. I have taken out two examples in case of a Maruti. All right, it is a Nifty auto company. Now let's talk about this example over here. Now this looks like what you're bearish engulfing. The red is completely engulfing your green candle. But is this actually your bearish engulfing? Give it a thought. No, this is not my bearish engulfing. Why? Because the first criteria itself says that the bearish engulfing should be spotted in an uptrend and never in a downtrend. Over here, there was an existing downtrend, and over there, we spotted this bearish engulfing looking pattern. So, this will not be known as a bearish engulfing. I will not consider this to be a pattern and I will ignore it. Clear? Let's talk about another trade over here. There's an existing downtrend. All right. There is a bullish engulfing. The green is completely engulfing the red, and in this case, it is covering the shadows of the red candle as well, which is covered under the signal enhancements point. On the next day, we get a flat opening, but still we have the buyers in control. Perfect. On the day of the confirmation, volume is good. On the day of the bullish engulfing, volume is just short of the average. So it does not really matter. I can consider that as good volumes, and from here, I would have longed the stock. And what has happened? There is a huge upside to the stock. All right, booking big profits to the trader. It depends on what sort of a trader he was. If he was a swing trader, he would have exited this position somewhere around over here. Finally, let's take a few examples from the Reliance chart as well. Now, over here, this is your bearish engulfing. Prior to your bearish engulfing, there was an uptrend in the market. So your first criteria is fulfilled. Let's talk about the second criteria, the confirmation. On the day of the confirmation, there is no gap down, but there are sellers in the market. Perfect. Now, on the third criteria is the volume. On the day of the confirmation, as well as on the day of the pattern, the volumes have almost touched the average. So again, I'll consider this to be good volumes. And in this case, I can again short the stock, and I have made huge amount of money over here. Let's take this final example. There is a bearish engulfing in an uptrend. All right. And on the next day, there is indecision in the market, followed by an indecision in the market, followed by a confirmation day. On the confirmation day, there were sellers in the market, but volume was weak. On the pattern, the volume was good, but on the day of the confirmation, volume was weak. Will I take a trade? No. In this case, I will not take a trade. You must be thinking that the price have fallen down, then why have I not shorted the stock over here? So of course, candlesticks are not to be used in isolation. There are a few more concepts. We will be combining this with your price action, and then you will understand why we did not take a trade over here on the short. Sorry, we would have taken a trade over here on the short side, provided if we would have combined this concept with your price action concept. But if you use the candlestick patterns in isolation, then I would have not taken a trade over here. And you also please take note that never use your candle patterns in isolation for your trading, because that will ruin your capital. All right. So make sure to stay safe, combine all your concepts, and then use it in the markets. Until then, you can do your paper trading. And if you have any doubts, take screenshots, send it on the WhatsApp community group. I will answer your doubts. Thank you.